But another aspect to running a fund that's really important to ensure you stay organized and to make your LPs happy is understanding target ownerships and fund return breakdowns. So there's no right answer for ownership, but there are wrong answers. I made a table that essentially is the breakdown of the average investment amount, ownership, and post-money valuation, and an example of a company that goes from an angel round to a $2.5 billion exit. So stick with me if you're listening, because there's going to be a lot of numbers. Essentially, in an angel round, an average investment would be a $250,000 investment for 10% of the company, which would value the company at $2.5 million. At an exit, that angel likely gets diluted pretty far down from not doing follow-on investing, as many angel investors typically don't do. So maybe while they own 10% initially, at the exit, they maybe only own 1.5%. But at a $2.5 billion exit, their value is now worth, or their initial $250,000 investment is now worth $37.5 million. That makes 150x on that initial investment. It's a great investment. For a seed stage fund, the average investment would be about $2.5 million for 20% of the company, which would value the company at $12.5 million. Again, at the time of the exit, seed stage investors get diluted pretty significantly. We'll say they own 10% at the exit, making their initial $2.5 million worth $250 million for a $2.5 billion exit, giving them a 100x on their initial $2.5 million investment. Next, for a Series A investor, the average investment amount is probably $7.5 million for a 20% stake in the company. That values the company at $37.5 million. Series A investor will get diluted a little bit, not too much, so they'll probably have about 15% of the company at exit, which values their stake at $375 million, which is a 50x on top of that initial $7.5 million of invested capital. Next, for a Series B investor, the average of a Series B deal seems to be around $15 million for 15% of the company, valuing the company at $100 million. Series B will get diluted a little bit to a 12.5% ownership stake, valuing their investment at $312.5 million on a $2.5 billion exit, giving them a 21x multiple on their initial $15 million investment. And lastly, in this example, for a Series C investment, call it $30 million for average, give them a 10% ownership stake, values the company $300 million. Since this is the last round that this mock company raised, they kept their 10%. They didn't get diluted at all. So they accrued $250 million of value off of that initial $30 billion of invested capital, giving them an 8.3x. Just a few things about these numbers before I go on. These are all estimates. Ownership at the time of investment this is an assumption I made based on many reports, and ownership at an exit similarly is an assumption I made based on various reports. Ownership could be higher for others. Some funds could get more diluted or less diluted. You never really know, but these are good averages. And if you're listening closely, you can see why venture favors seed and Series A investors the most. I mean, as we said, the angel investor returned a 150x, the seed was a 100x, the Series A was a 50x. I mean, these are very large returns. And investors prefer the seed and Series A because the angel round kind of de-risks the investment to the point where maybe the company now has a product in the market. At the angel round, you're basically investing in the team and the idea. There's not much around it. If you're lucky, they have a product in the market. Typically, they have a product by the seed stage. Maybe it's still just the idea and the team. But by the Series A, they typically have signs of product market fit. They have real customers. They have real traction. And so most investors consider the seed and the Series A to be the sweet spot of venture capital by weighing, what's the risk profile and what's the potential returns on the investments. It gets a little de-risked, but not too de-risked that you still get a really high multiple if you're correct about this investment. So seed and Series A are the sweet spot. Most people say Series A is the sweet spot. And lastly, a venture fund should hit these ownership marks depending on when they invest. So in our example, a Series A investor typically gets 20% stake in the company when they invest. That's generally how it works. But If a Series A investor can get 22.5% of a company, for example, that's fantastic. But if they're consistently only getting 12.5% of the company, then that fund is a lot less likely to outperform, since they will be getting significantly diluted to the point where they really don't own much of the company, maybe 5% if they're lucky at the time of the exit, whereas a 20% owner would own around 15% at the time of the exit. So that really changes the dynamic of the fund and how many unicorns or how many large exits you really need to hit to have a successful fund. So that's why ownership is so important. You're going to get diluted. You don't want to get diluted too much, because in a fund, you may only get one or two fund returners. So when you do get those fund returners, you got to make sure they really win when they do. So going into the fund, the last chart, I talked about the ROIs for that one investment. What's the multiple on that investment? So now another chart that I'm going to describe. Again, angel round, seed round, Series A, Series B, Series C, and then a $2.5 billion exit for the company. So the same average investments for an angel, average check would be $250,000. An angel also probably has 50 investments they make in their fund, because you got to make a lot of small investments hit the power law. You got to get one out of those 50. So throw as much out as you can. So if it's an average $250,000 check into each company, they invest in 50 companies, that makes the fund $12.5 million. Small fund, but a good size for an angel fund. At that $2.5 billion exit, that angel fund got $37.5 million on that one investment. So that 3X is the whole fund. That $37.5 million is 3 times more than the total fund size of $12.5 million. So that is fantastic for that angel investor. That angel investor just became a top quartile fund just on one investment, and will likely become a top decile fund off some of the other 50. That's why so many people love these small funds. So next is the seed fund. Again, $2.5 million average investment. Most seed funds make around 35 investments. Again, to weigh that risk and reward, get the power law effect. That would make this fund size about $87.5 million on a $2.5 billion exit. I estimated that they'd make $250 million on that. So that would be a 2.85x multiple on the fund. So that's really interesting, because again, that angel round, that angel investment generated a 3x for the fund. But that seed round did a 2.85x on the fund. So they're very similar, except the angel round returned 37.5 million, while the seed round returned 250 million. So that's a lot more total dollar value return on that multiple. So again, I talked about why a lot of people love seed and Series A. That's why. It's not just high multiples, it's also real dollar returns. So larger LPs can still invest in some seed stage funds. So next we have the Series A. Again, typical $7.5 million investment. Series A fund typically does around 25 investments. That would make their fund $187.5 million. Again, at a $2.5 billion exit, we estimated they'd return $375 million on that. So that's a 2x on the whole fund. Again, fantastic investment for Series A. Great multiple and a large dollar amount being returned, $375 million. Next, we have Series B, average $15 million investment. Likely make around 20 investments. That would make the fund about $300 million. At a $2.5 billion exit, we estimate they get $312.5 million back from that investment. Essentially makes their fund a 1x, a 1.05x if you want to be specific. So a good investment, but again, just not a lot of multiple, and actually less total dollar returns than the Series A investor. So that's also notable. Series C investor typically makes around a $30 million investment. They'll usually make around 15 investments. That puts the fund size at $450 million. Based on a $2.5 billion exit, I estimated their ROI would be $250 million. That only about 0.5x is the fund, so not even half. This just hammers down the point that seed and Series A, especially Series A, are the sweet spots of venture capital. That's why most LPs love to back companies. That's why Benchmark and Union Square Ventures are so beloved and have such great performances, because they stick to seed and stick to Series A, which are really the best places to work if you can dominate that market. So while seed and Series A is like the best place to invest, it's also the hardest place to invest because the benchmarks, the Union Square Ventures, the Sequoias, they're going to attract those top founders at those stages. So if you want to outcompete, you got to outcompete them somehow. Since it's the best place to invest, the best funds invest there. So it's ultra competitive. And also, as I kind of touched on before, these smaller funds, not so much at the Series A, a little bit at the Series A, mostly at the seed and the angel round. The top 10% get excellent returns, and the top 10 to 25% will have solid returns, but the bottom 75% will have average to bad returns. So if you're backing one of these early stage funds, you're backing a fund that you think can be in the top 10%, and at the very worst in the top 25%. So it's a tough business, and that's why we talked about many different aspects of being successful with venture capital in the first 3 episodes, because there's a lot that has to go right for you to be in that top 25% or that top 10% of the fund in all of the funds in venture capital, because that's the baseline. That top 25% is the baseline for you to return a respectable fund and to even stay in the business. Even if you're a top 30% fund, you're probably not good enough to stay in venture capital, and you're not going to be able to raise a second fund. So it's very tough. You really got to be one of the best in the world. So to further illustrate this point, I have one more chart. So this chart shows the returns of 11,350 companies in the last 32 years in relation to the size of the VC fund that invested in them. So for example, in this report, 11,350 companies in the last 32 years, 53.2% of those, so about 6,000 companies, returned less than a 1x. So if you put $1 million into this company, you got less than $1 million back. This includes $0 back, $200,000 back, $500,000 back, whatever, less than your original investment. So most of them returned less than your original investment. 27.1% returned a 1 to 3x on their investment. So $1 million, you either got $1 million back, up to $3 million back. So that right there is 80% of all companies that were invested returned 0 to 3x on that investment. Really tough, again, because as we talked about earlier in our investment example, we were talking about people getting 150x's, 100x's at the Series A and C stage. The vast majority of companies aren't even getting a 3x. So again, this is just how the power law works out in venture capital. 7.9% of those companies returned a 3 to 5x. Again, really not moving the needle. 6.4% returned a 5 to 10x. So now we're getting to solid investments. If you have 25 investments, you'll be happy if a few hit those 5 to 10%, 5 to 10x, but you definitely need more than 10x. 5.4% returned plus 10x on that investment. So whatever, 10x, 20x. But only 1.1% were a fund returner for that investment. So if you had a $50 million fund, only 1.1% of companies that were invested in returned more than $50 million. So as we talked about in that $2.5 billion company in our example, we talked about how that company returned the fund for a lot of people, but that's only happening for 1.1% of the funds. So again, in 11,350 funds, that means about 125 companies in the last 32 years were fund returners. So in 32 years of venture capital, there's only been 125 companies that have returned the fund for the investors that invest in that company. So that means about 4 companies are fund returners per year in the entire startup ecosystem. In the thousands of venture capital funds, the tens of thousands of startups, only 4 per year are fund returners. So if you're an investor and if your fund is 10 years long, you only have 40 chances to get a fund returner out of the 3,000 or 4,000 companies you'll be tracking in that time frame in those 10 years. So it's really finding a needle in the haystack. And sure, maybe 3 10x investments and 3 5x investments can return your fund. But that's also really hard to do. It's hard to find companies that even get that 5x investment. Again, only 12% of companies in the last 32 years have returned at least a 5x. So that in of itself is almost a 1 in 10 chance. That's already hard enough. So you can't bank on being able to just get multiple 5x investments, because whatever, hitting a 10% number 5 times is whatever that is, a 1% chance, 2% chance of that happening. So that's also very hard to do. And so that's why all venture capitalists view investments through the lens of whether they can return the fund, because that's what you really have to be targeting to get a great outcome. So if you're a $500 million fund and you think this company you're investing in can have a $250 million outcome for you, even if you're 50%, 60% sure that that'll happen, it's not worth the investment because it doesn't return the fund. So it's not worth the risk. If you lose the $30 million you invest in that company, that really hurts. And if you get $250 million back on that investment, yeah, it's nice, but it doesn't move the needle enough. So it's not worth the risk.